Car finance is just one of a number of finance options available to fund a car purchase. The purpose of this video is to give details of the different types of finance that you may wish to consider and whether they'd be suitable. The main 5 options are car finance, savings or cash purchase, personal loan, credit card, and mortgage. There are several types of car finance, and these are discussed in greater detail in the car finance video. The finance is secured on the car, and the advantage is that it can be cheaper than other options, and flexible options such as PCP can allow for lower monthly repayments. The disadvantages are that you do not own the car until you've repaid the finance in full, and your car may be repossessed if you fail to make your repayments. There can be limitations within the finance agreement in terms of mileage and wear and tear, and these are particularly applicable for PCP. And usually, though not always, you need to pay a deposit payment. Savings are the simplest option if you have the money available. You use the money in your bank account to buy the car outright. This is usually the cheapest option, as there are no ongoing finance costs, and it may mean you can negotiate a lower car price with the dealership. And the car is yours immediately, there's no delay arranging finance. The disadvantages are that once you've bought the car, the money is only available to you if you sell the car. So you need to consider whether any future events for which you'll need your savings and whether you have enough savings remaining to meet your needs in the foreseeable future. Another option to consider is a personal loan, either from your bank or from another finance provider. In this case, the finance is not secured on the car. If you fail to make payments on the loan, you're personally responsible, but your car will not be repossessed without a court order. This could be a cheaper option, and you do not need to pay a deposit. But there may be fewer options here than with car finance. For instance, the options available with a PCP car loan. And the borrowing amounts and terms with the lowest interest rates can be limited. Typically very small loans and very large loans may charge higher rates. And there is no voluntary termination option as available with car finance. And this is where you can end your finance after paying half the total repayments and return the car to the lender with nothing further to pay. Another option that you might consider is using your credit card if you have available balance. You need to ensure that you can afford the minimum payments on your credit card, and you need to be very confident that you'll pay off the balance in reasonable time. Otherwise, the interest costs may become very high and your debt may significantly exceed the value of your car. This can be a high-risk option unless you're confident that your total cost of borrowing will be cheapest using this method. The advantages are that it can be a cheap option if you have low APR on your credit card and you'll be able to pay down the balance within that low APR period. No deposit is required and no loan application is needed. You also get some protection if there's a fault with your car. Your credit card company is jointly liable with the dealer for correcting it. This applies to purchases between £100 and £30,000. However, the disadvantages are that APR rates can be very high on credit cards, so it can get very expensive. High levels of credit card debt can significantly lower your chances of getting additional credit. So if you're planning other finance applications such as a mortgage or a personal loan, this may not be suitable. You're also unlikely to get accepted for additional credit cards, and therefore it may not be possible to transfer your balance after a promotional period has ended. And there is a risk that the debt balance is not paid off in line with the reducing market value of your car, leaving a substantial debt compared with the car value, which could cause financial difficulties. The dealer may also charge you a fee for using your credit card. Depending on your mortgage, you may be able to increase the amount borrowed from your mortgage lender. The borrowing is secured on your house, so you must be confident that you'll be able to meet the increased mortgage payments. Otherwise, your house could be at risk of repossession. This could be a high-risk option unless you're very confident that your total borrowing costs will be lower and that you can meet the repayments and that you wish to increase your total mortgage. The advantages are that typically the interest rates are lower. You can repay the loan over the remaining life of the mortgage, meaning the repayment amounts are much lower. The disadvantages are that your lender may not allow increases and decreases or may charge fees. And the longer you take to repay the finance, the larger the amount of interest you pay, so the total cost of borrowing could be significantly higher. So how do you choose? Consider the types of finance available and that suit you. Consider what you can afford now and during the term of the finance. Find out the total cost of borrowing with each type of borrowing. You must be confident that you can make the repayments on your borrowing on time and without financial difficulty. Something else to consider is that if you have finance gap, this does not usually cover borrowing for your car purchase with credit card or mortgage, so make sure you check your policy documents.